If you clicked on this video, I'm sure you have applied for a lot of IPOs in the past or have plans to apply for them in the future. Have you noticed that only 1 out of your 8 to 10 friends who apply for IPOs actually get the shares? A recent hot IPO on Dalal Street was that of Cyient DLM, which raised 592 crores and was subscribed more than 67 times on the last day of bidding. We all know what happens to prices when demand is way higher than supply. So those 8 to 10 friends of yours who applied for the IPO but did not get the allotment, their buy orders actually increased the buying price of that one friend who got the allotment. If you look at the buy and sell orders for this stock trading in the secondary market, you will notice that demand is not 67 times the supply. So you need to remember this before congratulating that one friend who got the allotment. For retail investors, fundamental analysis of the business alone is not enough in case of IPO investing. Watching this video till the end will definitely improve your decision making regarding IPO investing. We are not only going to do fundamental analysis of Cyient DLM, but also going to discuss other factors which affect your IPO investing. So please stay tuned and make sure you subscribe for more videos on investing and stock market. Namaste and welcome to Retail Investing. So Cyient DLM raised 592 crore rupees through this IPO. The issue size was 1.33 crore shares, but investors subscribed for 89.73 crore shares. Retail investors bid 49.2 times their allotted quota of shares, and qualified institutional investors subscribed 90.44 times. So that's a massive demand-supply mismatch. The entirety of the 592 crore rupees was raised via a fresh issue. Offer for sale was introduced by SEBI in 2012 to help promoters of publicly traded companies to reduce their holdings and sell some of the shares to the public. As per regulations, public shareholding has to be at least 25%. Public shareholders include retail investors as well as institutional investors. A minimum of 25% of shares offered through offer for sale are reserved for mutual funds and insurance companies. The intent of offer for sale is not raising fresh capital. It is just a way of transferring ownership of shares from one shareholder to another. Hence, it does not increase the company's share capital, which you can find in the balance sheet. A fresh issue, on the other hand, raises fresh capital. It's a way for a private limited company to go public, which basically means that the general public can trade its shares in the secondary market. All the capital raised by Cyient DLM was by fresh issue. However, prior to the IPO, Cyient DLM had already raised 260 crore rupees from 20 anchor investors. The concept of anchor investors was introduced by SEBI in 2009. These are institutional investors who are invited to subscribe the shares before an IPO opens. The goal is to make the IPO look more interesting than it actually is and increase its popularity. The anchor investors are required to buy the shares at a fixed price to make other investors confident and increase the demand of the shares. Each anchor investor has to invest a minimum of 10 crores and they are not allowed to sell within 30 days from the allotment. It is beyond my understanding why this thing is allowed to happen. Making someone buy shares at a fixed price violates the principles of an auction market which is driven by demand and supply. This kind of investing artificially creates what is called a momentum. What do you think are the chances of retail investors making profits from this kind of momentum? Please type in the comment section. So the company deals in low volume, high mix products. It is basically the process of producing high variety of products in small quantities. This production method is commonly used to manufacture unique and more complex products with specific quality requirements. Things like printed circuit boards, cable harnesses, box builds. Most of these products are used in cockpits, in-flight and landing systems, and medical diagnostics equipment. The process involves contract manufacturing. A company gets into an agreement with local manufacturers in foreign countries to produce particular components to its specifications. It is commonly known as outsourcing. The products are of high quality and customized nature as per customers' requirements. Master service agreements for 3 to 5 years with customers are signed, which means it is very easy to predict revenues and profits in the near future. In this industry, there are high entry barriers because there is a need for technical expertise, and also the industry is heavily regulated. When it comes to revenue geography, in financial year 2023, 40% of the company's revenues came from India and 60% from exports. The company gets 20% of its revenues from aerospace, 37% from defense, 16% from medical technology, and 25% from industrials. Its clientele includes companies like Honeywell International, Thales Global Services, and Bharat Electronics Limited. One thing that retail investors should know is that the company's revenues are highly concentrated. The company gets 68% of its revenues from top 5 customers and 93% from top 10 customers. So according to the company, the fresh issue, which raised 592 crores, will be utilized for funding incremental working capital, funding capital expenditure, repayment of borrowings, funding acquisitions, and general corporate purposes. Now, if you look at the P&L statement, you will see that the company's revenues have doubled in the last 3 years. Its earning per shares went up to 291 in FY 2022, but now it has fallen to 7.75. At the 2004 annual meeting of Berkshire Hathaway, Mr. Warren Buffett said that IPOs closely resemble a negotiated deal. A negotiated deal is the opposite of what happens in an auction market, which our stock markets are. In a negotiated deal, the seller and only a few buyers decide the terms of the deal. Mr. Buffett said, and I quote, "In my view, you are way more likely to get incredible bargains in an auction market. It's just the nature of things. Sometimes there will be IPOs in terrible markets and they may come very cheap. But by and large, that is not when IPOs come. They come when the seller thinks that the market is ready for them, and they come with an informed seller thinking it's a pretty good time to go public. And you will always make better buys, in my view, in an auction market." How can I disagree with that? Cyient DLM seems to be a good business, and it is likely to be available at cheaper valuations in the future. According to many legendary investors, one of the greatest skills required for success in stock markets is patience. Any retail investor who can sit back, relax, and watch has high chances of succeeding. Valuation guru Professor Ashwath Damodaran says that IPOs are priced, not valued. I cannot argue with that. So whatever the price at the moment is, it does not affect the quality of the underlying business. Cyient DLM seems to be a good business so far and definitely deserves a place in my watch list. Being a supplier to defense and aerospace manufacturers, it has good potential for growth in the coming decades. The company already has a strong order book and industry tailwinds in its favor. However, post-IPO valuations don't look attractive. Many research analysts are not recommending the stock as of now. Existing shareholders are likely to gain from holding the stock for the long term. Please don't consider any of this as buy, sell, or hold recommendation. This video was for educational purposes only. If you got any value on IPO valuations, feel free to like, subscribe, comment, and share. Especially share this video with that one friend who got the IPO allotment. Thank you very much for watching, and I'll see you in the next one.